Hi, financial year 2020-21 is about to end. This is the last Ilanomics for this financial year, and what a financial year it has been. COVID, lockdown, slowdown, loan moratoriums, recession, steep fall in growth, followed by recovery, much lower rates of infection and deaths in India than people had forecast and feared. And now suddenly we are, into another new round of infections and sporadic lockdowns in some parts of the country. And there is a fear again that this has become a terrible repeat nightmare coming back to us. So what did we learn from the last financial year, and what does the next financial year 2021-22 look like? We have Professor Patnailk to talk about this. We've been with you through this financial year, and we will be there with you the next financial year. I'm YP Rajesh, Managing Editor of ThePrint. Please send us your questions after we finish our initial round of discussions. So welcome to this new episode of Ilanomics. Ila, you've written a column today which we have published in ThePrint, your weekly Ilanomics column, where you have looked forward. Before I ask you for your views on the next financial year, what is your one big takeaway from the year we are leaving behind?
I think it was one of the most difficult years, and I don't think there's anything new in what I'm saying, but it was one of the most difficult years of our lives for most of us. We've not seen anything. Most of us haven't seen the world wars, I suppose. So it was a year when the year began, we didn't know what hit us. The lockdown, the pandemic. Of course, there were people who were hopeful that things would look okay. There were people who were very pessimistic that things would be very, very bad. I think what turned out was many twists and turns, many ups and downs. Many hopes were turned out to be right, and for many it was a very, very difficult year for millions and millions of people who lost their jobs, who lost their livelihoods, who are now indebted, whose businesses are in deep trouble. It has been a very difficult year. Psychologically, it's been a very difficult year for most of us. And, good news and bad news kept coming. We never knew when a vaccine would come, and then people would get scared. So, in sum, for most of us, it has been one of the most difficult years of our lives.
It's very difficult to disagree with that, Ila. And like we were discussing also earlier this week and planning what we want to talk about today, we saw all these developments that are happening simultaneously. The new surge in infections, the loan moratorium decision from the Supreme Court, the insolvency process will start now again. Bad loans will start coming into the picture more clearly. We know the health of our banks. At the same time, the government presented a very, very reformist budget. Those things promised in the budget will start rolling out from the 1st of April. Disinvestment, shutting down or privatizing, rather not shutting down, privatizing public sector companies. So you talk about the coming year being one of high growth and high volatility. Can you discuss high growth and high volatility separately?
Yes. So remember that anything that happens this year, in terms of the growth numbers, or any numbers, inflation numbers, growth numbers, all are going to be compared to last year. And last year was a low base, because we actually saw a contraction in GDP. We saw a contraction in many things. And given that even going back to where we were at the beginning of last year is going to be positive growth, annual growth. So increase this year over what we saw last year is going to be positive. What we are likely to see across the world, not just in India, but across the world, is going to be high GDP growths. So output is going to rise, employment is going to rise. Now, even though COVID waves are still coming, but the fact that we have a vaccine, we have many vaccines. The fact that we have vaccines, that we vaccines do give us, whether it is 60%, 70%, 90%, but they do give us some protection. So, but the fears may continue because, many people, if it's giving us 75% protection even after a second dose, then there are people who will get it again. So, the fears will continue. There will be a lot of there will be ups and downs, but still output is going to be most likely output is going to be higher and growth is going to be higher in terms of the real sector. So employment and growth, incomes will rise, spending will rise. But I think one of the most difficult things that we are likely to see is what we've written about, my co-author Radhika Pandey and I have written about, is the high volatility that one is expected to see in financial markets. Now, what's shaping that is the fact that almost all governments across the world are going to be borrowing a lot. Lenders like households who lend through uh, mm, banks, pension funds, insurance companies. I mean, those are only the intermediaries. Ultimately, it is the households whose financial savings are channeled through those. I mean, it's not that corporates have a lot of financial savings. It's the bulk of financial savings come from households. Households are not willing to accept very low interest rates. So what we expect to see in financial markets this year is that while governments and central banks will try to keep rates low, central banks will also have to struggle. I'll come to that because they have to find this balance between inflation and growth. But governments, certainly, the ones who are borrowing, would certainly like to see interest rates being low. But markets, where where the buyers are, where the lenders are, financial markets would like to push up those interest rates. And we saw that happened after the FOMC meeting of the Fed, when the Fed did not raise rates but raised its forecast of inflation and growth. It's happening in India, where the RBI has in fact in its monthly bulletin said very interesting things about bond vigilantes and how the bond vigilantes are doing a tandav and that they need to behave themselves for keeping markets stable and they to keep interest rates low, because central banks will be pushing in liquidity and hoping that with that increase in liquidity, interest rates will remain low. But people are not willing to lend to governments all this increased amount of money that governments want to borrow at lower rates. So they are pushing rates high. And because asset prices get determined by what interest rates are. So we expect that asset prices will jump around a lot, whether it's bond prices, whether it's stock markets. So the year is likely to see a lot of volatility in this tug of war that is expected to continue between government and central banks and the buyer of bonds, or the savers in the economy. And with this tug of war continuing, I expect that volatility in financial markets will be high this year, even though there'll be high growth in terms of output and GDP growth.
One last question from me, Ila, before we take questions from our viewers. We have a lot of questions already lined up. With the insolvency process resuming, bad loans coming much more clearly into the picture, do you think this, bad news, so to speak, will actually affect the momentum, Ila?
See, banks will have to now recognize their NPAs. And if they have to recognize NPAs, and if they are much bigger, as is expected, because businesses were in trouble during the pandemic, and they have to put more capital aside, or they have to slow down the rate at which they borrow, assuming that there is increased demand for credit, which is also not rising very sharply, actually. But if there is increased demand for credit, then banks will need more equity. The government is not particularly in a position to give to add, at least for public sector banks, the government is not in a position to add equity to banks. Private sector banks won't have been making all those that much profits that they would be holding retained savings, which goes back effectively as equity. So rising NPAs will certainly stress the balance sheets of banks. But there's no way out of that, because if you continued with the moratorium, if you continued with not recognizing your bad loans, and you had to still pay out your depositors, you had to still give interest to depositors, you still had to return depositor money. And how would when they want it? So how would you do that, unless the health of the banking system is taken care of? And this is, of course, a difficult thing, but I guess one has to face it at some point. So it's good that we are going to start facing it. Also, the longer that a business is not, suppose a business gets into trouble and it's not sold off and money is not recovered, it becomes less and less valuable, and the amount that can be recovered from it becomes less and less over time. It just depreciates and falls apart over time. So you don't want to delay this process too much also.
Ila, we take questions from our viewers. We've got a bunch of questions, but before we take questions, I want to just remind our viewers, we've been with you through this financial year, and you've been with us through this financial year. I'm sure you have gained a lot by watching our show and our discussions. And if you have to do one last good thing in this financial year, that should be taking a subscription to the print. You must be seeing a lot of advertisements saying 5 days left to save tax, gain benefits and rebates. You will gain a huge news benefit by subscribing to the print, because we need good journalism to survive and gain momentum and traction. And this is going to be your investment for the next financial year. So go to the print.in/subscribe. We will give you the link in the description of this video, and take a subscription for this financial year that is about to end, and you will be doing good journalism, a good, great deed. Uh, Thank you, and I look forward to those people who have not taken subscriptions to helping us out. Uh, First question, Hila, is from actually Rishabh J. Thank you, Rishabh. Uh, it's a very a general question. He says, should India shift from year on year to quarter on quarter GDP results?
See, quarter on quarter GDP requires seasonally adjusting. Both are useful. So it's not that one has to make a shift and not look at one and the other, but quarter on quarter requires making seasonal adjustment. And this has been a debate that has been going on for quite a while. In fact, we have been, so at NIPFP, my colleague Radhika, who's my co-author in this, has also been involved in that work of seasonal adjustment. And we've been doing seasonal adjustment. And earlier, we even used to release that the indices that are required. But normally in other countries, it is the statistical office that does this. So MOSPI should be doing that seasonal adjustment. And then we could look at quarter on quarter, and we would get more timely information on how the economy is moving based on that. There are also many indicators where we would look at month on month growth rates after seasonally adjusting them. But till MOSPI takes up the responsibility of releasing seasonally adjusted Q on Q or MOM, month on month or quarter on quarter figures, we can't really depend on what we have. So even though we do that, but we should be moving to those. We should certainly start releasing those, so that we get a better sense more quickly of which way the economy is going.
The next question is from Aditya Gupta. It says, do you think US could sign something like a Plaza Accord to willfully depreciate its currency to counter China? And what will the impact of something like that be on India?
I think it has become very, very difficult for central banks to fix exchange rates as the world has become more and more globalized. The large amount of trade that happens, the large amount of capital flows that happen, so this level of capital flows were not happening earlier. And now, if central banks try to go to uh, say fixed exchange rates or try to manipulate currencies, then it is not that easy because it does have consequences. So, there could be many ways of doing it. Either you have an official rate which you try to stick to, and one possibility is that black markets develop because you try to have an administered rate the way India used to have. So if the US tries to do something like that. Second could be that the US could intervene in foreign markets to bring the exchange rate to the one that they decide to keep to. The third could be that they try to manipulate interest rates so that they keep the exchange rate at a certain level. Now, all of these have consequences for the domestic economy. And the reason why countries have moved more towards, China hasn't, but why other countries, Europe, a lot of, to a large extent, India as well, but certainly the US has moved to moving to inflation targeting, where you do counter-cyclical monetary policy instead of doing exchange rate targeting, uh, is because the domestic consequences of exchange rate targeting are often such that they give you pro-cyclicality. They exacerbate business cycles, make them worse. So, if you're going up, you go even more up, and if you're going down, you go even more down. So because of that reason, fixing exchange rates is not something that I expect the US would go back to. So, and I don't think it'll be a good idea either.
Uh, Drona Kurana asks us, what is your take on Niti Ayog's statement that it is a bad idea to privatize small PSUs? Why is it a bad idea to privatize small PSUs first?
So I'm not sure why Niti Aayog has said that, honestly, because whether it is small, whether it is big, the criteria should be, and that's what the government has said. The criteria is that it should not be in a strategic sector, and if it is non-strategic, so whether it's a small hotel or whether it is a large, an ITDC or something, or an MTNL, which the government is putting its management resources into. So there's a lot of management resources of the government that go into PSUs. So whether it is small or whether it is big, I believe that as long as it is in the non-strategic sector, so maybe nuclear you don't want, or certain other sectors you don't want, but for the others it should be uh, in the private sector, particularly when there are already companies in that sector which are private.
This is a question bothering all of us. Amit Kokate, thank you for your question, Amit, asks us, please tell us, will the resurgence of COVID hurt the economy too much? And yesterday, Governor Shaktikanta Das said it won't, but I'll wait for Ila's take.
Yeah, I think I agree with the governor that it won't hurt it as much. You see, now remember that when we had the last year when we had the first lockdown, it was really suddenly everything was shut. Okay, we didn't even know how to work from home. I mean, I remember I was going to the print office for these live videos. There, we hadn't worked out how to do things remotely, and that was a time when in the first quarter we saw a contraction of GDP. So a very sharp, nearly 24%, a little above 24% contraction of GDP. Are we going to see something like that again? I doubt it. So yes, COVID is spreading. First, according to whatever reports one is reading, it is not as deadly. People are not as scared, and there is now that there are vaccines available, and slowly the population is getting vaccinated. So perhaps if we go back to a lot of these safety measures that we were employing earlier, uh, along with our higher ability to work from home, to work remotely, to be able to work around this pandemic, I don't think that we are going to see a quarter of 24% GDP decline again. So it won't be that bad. At least that's what I
Hope
think.
that answers your question, Amit. There are two questions from two different people asking similar things. So I'll club them, Leela. One is Kunal Yadav asks us, thank you, Kunal, for your question. Is India moving towards cyclical growth or structural growth? And then there is Saurabh uh, Mate, I hope I pronounced that correctly, Saurabh. Uh, does India really face the risk of a middle income trap? What does India need to escape from it? Structural growth, cyclical growth, middle income trap.
So let's go to this question of structural and cyclical growth. Now, let me start with what uh, you see in advanced economies. In advanced economies, typically you see business cycles, and it's something that has been studied for now nearly a century. And so periods of high growth are what you may, I think, what the questioner here wants is calling cyclical growth, that for some time you have high growth, and then it's almost like a cos and a sine, the curve, where you'll see high growth and then the growth comes down and then it goes into a recession and then it goes into a recovery. So that's a typical pattern that you see. Now, the difference between that and the kind of growth that you see in emerging economies, which is being called structural growth here, is that emerging economies actually see a combination of both cyclical and structural growth. What is being called structural growth? Let's just imagine a trend line, uh, draw it from the mid 90s, let's say 91, 92. So after the liberalization, you would see a trend line like going like that. But around that trend line, there have been periods of high and low growth. So I could draw that trend line at something like 6.5% or so. Okay, but it is not that it is only structural growth. I'm trying to use the vocabulary of the questioner here, that it is not that we are steadily growing at 6.5, or that we are steadily growing at 4 or at 9 or whatever might be the structural growth. What we are seeing here, and not just in India, we are seeing that in all emerging economies, is a cycle around a trend. So there are periods when the growth rate goes up. So there are many ways of disentangling the cyclical from the trend component or the structural component. And one way of thinking about it is that you take out the seasonality, you take out the irregularity, and then you can separate out the trend and the cycle. There are various Hodrick-Prescott filters, and I assume this is a student of economics. So, if you use the Hodrick-Prescott filter, which is one of the old, very well established techniques, then you could use those filters. And Radhika and I, my co-author in this column, and I have papers on this, which are available on the NIPFP website. So we've been doing business cycle research for about 20 years now. And what you see typically is that when you have a growth, have this cycle around the trend line, then uh, it's not that every time you have a slowdown, growth will collapse completely. Not in an emerging economy. So unlike last year, where you actually saw a contraction, normally you don't see a contraction. You'll always see some growth happening. Last year was very, very different. So if that answers the question of trend and cycle. For the middle income, I would say the right person to talk to is Rathin Roy. He's talked about this and he's written a lot. So, since we're running out of time, I'm not going to take this question and refer you to his columns.
Shrikant J has a question which must be bothering a lot of people who have money in small savings. Can we expect an increase in small savings scheme interest rates for the first quarter of FY22? I don't know why he's specifically asking about Q1 FY22 by the government.
So, I'm not a fortune teller, and I can't say whether Q1 will have higher interest rates or not. But I can basically talk about the mechanism and the forces that are at play. And the forces that are at play now is this tug of war where uh, there will be savers will want higher interest rates and governments will want to pay them lower interest rates. In all probability, central banks will be on the side of the government. So, for example, in India, the Reserve Bank of India is the debt manager of the government. And as being the debt management office of the government, it will try to keep interest rates low. The total interest payout that the government makes, it will try to keep that low. So trying to keep that low, it will try not to raise interest rates. However, there'll always be this pressure from the bond market to push rates up. So I don't think that, in balance, what you might have is that rates stay where they are for small savings, that they stay where they are, that neither side actually wins. But of course, we'll have to wait and see how it unfolds in the next few months.
We have time for maybe one or two more questions, Ila, and then we will wind up quickly. Preeti Shekaran asks us, and this is something we've tackled before, Ila. She wants your opinion on the pattern of bond yields going forward in the new financial year. We did an entire episode on bonds and why bond markets are worried. You should go back and refer to it. It was in the last 2 weeks, Preeti. But do you want to talk about how you expect bond yields to go in the next year, quickly?
Other than the fact that I expect them to be very volatile, I mean, I would say that there would certainly be upward pressure. Large government borrowing programs means that there will be upward pressure. So I would expect there would be upward pressure, but then there would be volatile given how central banks will pump liquidity and try to keep that pressure low, try to counter the pressure.
We'll take one last question, Ila. It's from Devendra Sahu. What is your opinion of the RBI's US dollar holding? Do you think RBI should give away some part of it to the government so that the government can spend it on sectors like infrastructure and defense?
See, people have to understand the monetary base cannot be given away to anybody. All that the RBI can do is substitute US bonds for Government of India bonds, for which they would have to sell their US dollar holdings in the open market. And then in exchange, if it wants to keep the monetary base the same, it will have to buy those bonds. It cannot gift its dollar reserves to the government. I think last time also we discussed this question, and maybe a couple of times before that as well, because it keeps coming up that, okay, so you need to go back to what is the monetary base. Okay, reserve money is RBI's holding of net foreign exchange assets, which are its US dollar holdings, and net domestic assets, which are its government of bond, the Indian government bond holdings. And that constitutes your monetary base. You don't give it away to somebody, it's just not possible. This is not something that we should think about or discuss. It's just not possible.
Ankit, we have a last question from Ankit Nakshane, and it is truly the last question. And I apologize to other viewers, we couldn't take your questions. Ankit wants to know, by when will India become a $5 trillion economy, which has been delayed due to the pandemic?
So it depends on the rate at which India will grow. It depends on the reforms we have. It depends on the functioning of the financial markets. It depends on the global economy. I think all that put together, if there is healthy growth, then we should be back on track to trying to achieve that target sooner or later.
Thank you, Ila. Thank you so much to all our viewers for watching this episode, this special episode, end of the financial year. We will be back next week. It's a new financial year, and let's all hope it will be more high growth and less high volatility.